Hello and welcome to EduFund. In today's episode, we have a very special guest with us, Tejas Gutka, who is a fund manager with Tata Mutual Fund. Tejas brings along 15 years of experience. He joined Tata Mutual Fund in 2019, and prior to joining Tata, he worked with Tamuhara Investment Managers, he worked with Barclays Wealth India, and also Care Ratings. Qualification-wise, Tejas holds a MMS degree and a BSc in Mathematics from Mumbai University. Welcome to the show, Tejas.
Thank you so much.
So, we wanted to understand from you, you manage three funds at Tata Mutual Funds. One is Multicap Fund. Let's start with Multicap.
Sure.
What do you see the difference between Multicap versus a FlexiCap fund? And what are some of the key characteristics which an investor should look at while deciding between any of the fund?
So, FlexiCap, as the name suggests, is a flexible category, which means that the fund manager has the flexibility to go to whatever market cap segments that the fund manager prefers or finds attractive. Multicap, on the other hand, has certain regulatory restrictions whereby 25% of the portfolio has to be allocated to each of large cap, mid cap, and small cap. And the last 25% is where you have the flexibility to decide where you want to move. So, in a sense, FlexiCap can move to any one market cap segment if they wanted to. Whereas a multi-cap fund can't have more than 50% allocated to any one market segment, right? So that's the regulatory restrictions that the multi-cap funds have to work with. In my view, these regulatory restrictions are actually an advantage towards the category. See, typically what happens is, when one segment does very well in the market, it becomes extremely difficult behaviorally to move to something that is not doing very well in the market, right? And your investing theory teaches you that you need to buy low and sell high, right? Which means you need to go from a category that's outperforming more towards a category that's underperforming from a cycle perspective.
Yeah.
In a multi-cap fund, let's say you started a multi-cap fund maybe 2 years back, and you had a very large allocation to mid-small caps and lesser allocations to large cap. Given how mid-small caps have performed over the last 2 years, your weights in mid-small caps would have significantly increased over this period of time. So the fund would force you to take out some profits from mid-small caps and go more towards large caps. And that cyclically, we think will work in the longer term towards the investor's advantage, because essentially you're selling something that has already become a little expensive relatively and buying something which is cheap relatively today, right? So I think that's the beauty of multi-cap funds.
Do you think this also change your risk management practices in some manner?
Not in a very big way. Yes, you do have to be mindful, given that you at all points in time need to be invested 25% in each category. Sometimes you may find that the category is looking expensive, and therefore you've got to tread very carefully in that category. Like I said, you don't have the leeway to get carried away with valuations, and you've always got to maintain a balance.
When we talk about the construction of the portfolio, how do you try to balance between top-down approach versus a bottom-up approach?
Sure. So, the way we look at this portfolio is that we are completely bottom-up. We don't do a lot of top-down investing here. We don't even do a lot of benchmarking here. The way we are looking at the multi-cap fund is that we've divided the fund into 3 buckets, each bucket defined by how the underlying earnings behave for stocks in that bucket. So the first and larger bucket for us in that fund is called earning stability, which is where we try and buy into companies where the earnings volatility is very, very low. Right? These are stable growth companies. They may not grow at a very high rate, but there is more predictability of earnings here. So they provide us some sort of a base to the portfolio, right? That's about 40-45% of the portfolio. The second bucket is what we call earnings upgrades. These are potential investments where we think over the next 12 to 15 months, the earnings can accelerate much faster than their historical averages. So typical cyclical sectors like banking and auto, where you have 1 or 2 years of down cycle followed by an up cycle. We try and play these high beta sectors in this segment of the market. This is about 30% of our portfolio. This gives you a market plus a certain
This also
return, right?
adds to the alpha part.
Yeah, so this is like a higher beta than the market, and therefore gives you a little over the market. The third is our pure alpha segment, which we call earnings turnaround. This is where we look at stocks or sectors that have gone through 4-5 years of pain. We think that the pain is bottoming out here. We don't have an immediate visibility of the pain turning into gain, which means we don't know if it'll take 6 months or 18 months for these earnings to bounce back. But we think they won't fall further from here. And therefore we go and sit in these kind of sectors. We've historically observed that whenever there is a sharp turnaround in earnings, you get dual advantage. A, there's a very sharp growth in earnings over the next few years, and with that the multiple also expands. And therefore we think this is the pure alpha segment where in addition to a faster earnings growth, will also benefit from an expansion in the earnings multiple, and that is how at a portfolio level we think this segment can add a reasonable alpha to the portfolio. So the first segment gives you closer to market linked returns, the second segment gives you a little better than market returns, and the third is the pure alpha segment of the portfolio.
How does the sector allocation works in this kind of a fund?
So again, the sectoral allocation is determined by how we are looking at stability versus turnaround versus upgrades. It's less to do with how the index is structured and more to do with our views on different sectors and where we think each of these sectors is in their respective cycles, and then accordingly we'll allocate money within these sectors or to stocks within these sectors in the three different buckets.
Let's move on to the next fund, which is Housing Opportunities Fund. That fund is very closely, a thematic or a sectoral fund. How do you see that fund, and what are your growth prospects about that fund?
Sure. So housing, the genesis of the Housing Opportunities Fund lied in the fact that, we thought that the real estate sector was turning around. Real estate in India is a very deep cycle sector. You have 7-8 years of down cycle followed by 5-7 years of an up cycle. We thought we were at the beginning of a new upcycle. We'd seen last 10 years, which was the down cycle for the sector. A lot of the macro indicators for real estate were turning around. Now, the problem with our real estate sector is that there are not enough investable opportunities for you to create a diversified fund. So the reason we looked at it as a housing opportunity fund was threefold. One, like I said, we didn't have enough ideas to create a diversified fund. Second, each of the real estate companies is very micro market focused, and therefore something going wrong in a micro market can create problems for any of these holdings. And if you had too much concentration in these names, then your returns get impacted. And third is the cyclicality, right? Real estate goes through very sharp up and down cycles. Right. In an up cycle, you see valuation expansion. In a down cycle, you see earnings and valuation contraction.
Yeah.
And therefore, stock prices will move up in an up cycle and then correct sharply in a down cycle. So from an investor perspective, you don't want to offer a product where you have to time the cycle.
Yeah.
And therefore, we said, let's look at all the ancillary industries related to real estate. A lot of these problems get solved there. We may buy a house maybe once, twice, thrice in our lifetime. But for each of these houses, we'll kind of do a renovation every 5-8 years, right? Which means that all of the ancillary industries have an inherent replacement demand.
Yeah.
So even in a down cycle, their top lines continue to grow, albeit at a slower pace. So they'll grow at slower pace during a down cycle and a much faster pace during an up cycle. So you get a reasonable downside protection as well as an upside participation. So that's how we looked at this fund. It's a fairly concentrated portfolio of about 25-30 holdings across 10 odd industries, all of which are directly linked to the capex and real estate cycle. This is a pure housing fund. The underlying benchmark has housing plus some infra opportunities. So this is a fund that is slightly deviated from its benchmark. The benchmark is 50 stocks with 90% large cap. We are 25 to 30 stocks with only about 55% large cap.
Okay.
So we have a reasonable differentiation from the benchmark, so to say. Most of the ancillary companies to the housing sector are consumer-oriented businesses, but these are very small businesses. So for example, when you look at the largest tile company in India is a 5,000-7,000 crore revenue. The largest ply company is a 2,000-3,000 crore revenue.
Yeah.
So these are all mid-small cap companies, very early in their cycles of formalization.
Yeah.
And therefore, there's a very long growth and margin runway for most of these companies, right? So you started with a subject that was cyclical, and you end with a portfolio that is more structural, has a very long growth runway and much lower cyclicality. So that's how we thought of this product, and that's how we've created it. While it's a thematic portfolio, it's not really a sector fund where you need to time in your exits and entry. We think this is a structural portfolio where you can remain invested for the next 5-10 years. If you believe that India is a domestic consumption story, then the smaller parts of the domestic consumption story are all part of this fund, and there's a reasonable allocation to all of these opportunities, which you may not find in a diversified fund or even in a consumer fund to the extent that you find it in the housing.
You mentioned about that in this fund you have roughly around 50% in large cap versus the benchmark, which is skewed towards 90%. Also, we know that this fund is more like a thematic fund. So how do you manage risk in this kind of a portfolio?
So I think risk comes from 2 or 3 aspects. One is the business model risk, where again, like I said, most of these are consumer facing businesses, so there's no leverage. There is ample cash generation. The ROC, ROEs are good. The quality of management is fairly decent. We usually stick to only leaders or challengers, which means we're buying the top graded companies of every sector. That's how we manage the fundamental or the quality risk of the portfolio. Okay. The second risk is valuation risk, right? Here, this is where I think we have some churn in the portfolio. Otherwise, this is more a buy and hold portfolio. But wherever we think that the valuations have run ahead of fundamentals, we bring down the weights of those names in the portfolio. Wherever we think that the valuation offers a reasonable upside, we'll bring up the weights of those segments in the portfolio. So for instance, when we started the fund, we thought that the mid and small cap segment was a little heated. So we went to a largely large cap allocation in the fund. Over the next 6-8 months, as we saw correction in mid small cap stocks, we increased our allocation to mid small cap stocks. Right. We started with with a higher allocation to some of the beaten down names in terms of oil related beaten down companies where profitability had taken a very large hit. Now we are trying to reduce weights there and move to other segments which we think are more structural, as well as provide some downside protection, because we think that market valuations are also a little ahead of long-term averages. And therefore, that's how we manage the risk within the portfolio.
Let's move to the ELSS funds. You also manage the Tata India tax saving funds. Can you throw some light about the growth in the fund and the philosophy on the process which you follow in selecting the stocks, given that you also know that the investors' funds are logged in for 3 years? Does that aid to your decision-making process?
For ELSS specifically, the portfolio, we have a two-fold strategy in the portfolio. 75% of the portfolio, we try and capture the compounding stories where we think that businesses that can grow at 3 to 5 years at a reasonable rate of growth and are available at reasonable valuations. 70% of the portfolio is allocated to such names. 30% of the portfolio is where we try and play misunderstandings, where we think that the market is misunderstanding the business for one reason or the other. Maybe the business is going through its own inherent challenges or a cycle, or maybe there is some macro issue because of which the business is suffering today, and we think over the next 3 years the business will outperform expectations, and therefore you'll have a multiple kicker in addition to a faster earnings growth. So it's a 70-30 balance between compounders and misunderstandings. That's how we typically structure the portfolio. In terms of lock-in, I think the lock-in adds an advantage to the portfolio because you typically, ELSS anyways is a low ticket size investment for most investors. So you don't have chunky inflows and outflows. The inflows and outflows are both very smooth. That helps us manage the portfolio better, because typically when you have chunky inflows and outflows, they'll happen at the wrong part of the cycle, right? After the market is done very, very well, you see a lot of chunky inflows and it becomes difficult to deploy them. Similarly, after a sharp correction in the market, you see some lump sum withdrawals from portfolios, which creates a problem for you as a fund manager. In this category, we don't see those issues, and which kind of helps us to ride smoothly across market cycles. The lock-in also helps us to take advantage of some of the smaller segments of market cap, or go to slightly more lesser liquidity kind of names in the market cap space, because we know that we have a 3-year horizon here, and therefore we can play some of these cycles. So this fund has managed the small cap exposures very, very well. In 2020, we had about 7-8% allocation. Over the last couple of years, we've increased that to about 20-25% allocation. So we're able to move between market caps very easily, simply because we don't have large inflows and outflows in the fund.
All right. People are talking about a very high valuation in the Indian market currently. I mean, market's at 73,000. Many people are saying that, should I wait for a correction? Do we actually foresee a correction because of the geopolitical issues which are currently going on, and also the general elections which is due? What is your advice to our viewers who are retail investors about how should they participate in this market, particularly when it comes to a thematic fund like housing opportunities, or maybe a ELSS related tax saving fund?
So for most of our funds, our advice is that at these levels, you should definitely stagger your investments rather than going in lump sum, because as you said, we are already trading at above average valuation. We think there are good reasons for us to trade at above average valuations, but obviously that opens up the risk of a small correction at any point in time. We've over the last couple of years seen many 8-10% kind of corrections in the market. So when you stagger your investments, you're able to take advantage of these corrections that happen in the market. And therefore, staggering, I think, is one of the better strategies in a market like this. After that, we think that within the 3 market cap segments, our preference is more towards large caps, followed by small caps, and then last mid cap. That's how we think valuations are placed today, where mid caps are at the most premium to their history compared to small caps, and then large caps, which we think are at largely average levels. And therefore, we think from an allocation perspective, look at funds where you have larger allocation to large caps rather than chasing mid small caps at these valuations. If you are allocating to mid small caps, then also buy some protection in the form of, let's say, a balanced advantage fund or a multi-asset fund, where you're diversifying or you're creating a barbell where at one end you have higher risk category, at one end you have a very low risk category, and then whenever you see a sharp correction in market, you kind of shift your allocation. So we think this is the time to be really thinking or focusing on allocation at a portfolio level rather than any one segment of the market. That's how we would navigate this kind of a market.
Wonderful. Thank you. Thanks a lot, Tejas, for your time today. And I hope our viewers would definitely take ahead some learnings and insights about how to participate in this current market. Thanks a lot for your time.
My pleasure. Thank you.
So that was Tejas Gutka from Tata Mutual Fund. He manages Tata Housing Opportunities Fund, Tata Multicap Fund, and Tata India Tax Saving Funds.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.